Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Momentum, Value, and Growth Investing. The section goal is to understand the portfolio strategies and evaluation, and the module goal is to understand some strategies in portfolio management. First, let's talk about the momentum. Momentum investing is a trading strategy in which investors buy securities that are rising and sell them when they look to have peak. The goal is to work with volatility by finding buying opportunities in short-term uptrends and then sell when the securities start to lose momentum. Smart beta investing is passive in the sense that it adopts a systematic approach where trading only occurs in order to rebalance the portfolio back to its intended factor exposure, rather than at the discretion of the investor. These factors include momentum. There are two forms of momentum: time series momentum and cross-sectional momentum. Time series momentum is where a security's own past return predicts its future return. It is also known as a trend following strategy. It's a simple extension of the long-only constant volatility strategy of equation that involves both long and short positions as defined by each asset's recent performance over some look-back period. Cross-sectional momentum is where a security's outperformance relative to its peers predicts future relative performance. With cross-sectional momentum, this involves ranking stocks on the basis of their performance over the previous J months and then identifying as winners those stocks that rank in the top of the distributions, and as losers those stocks that rank in the bottom. Overreaction occurs when decision makers respond disproportionately to new information. Underreaction means that investors do not react enough to information. This is one of explanations of momentum. Next, we are discussing about value investing. Value investing has taken many forms since its inception. It generally involves buying securities whose shares appear underpriced compared with intrinsic value. As examples, such securities may be stock in public companies that trade at discount to book value or tangible book value, have high dividend yields, have low price to earning multiples, or have low price to book ratios. Some aspects of value investing include passive screening. Following in the Ben Graham tradition, you screen for stocks that have characteristics that you believe identify undervalued stock. You are hoping to find market mistakes through the screens. Second one is contrarian investors. These are investors who invest in companies that others have given up on, either because they have done badly in the past or because their future prospects look bleak. You are implicitly assuming that markets overreact. Third is activist value investors. These are investors who invest in poorly managed and poorly run firms, but then try to change the way the companies are run. We also list passive screeners Ben Graham screens. Benjamin Graham was an influential investor who research in securities laid the groundwork for in-depth fundamental valuation used in stock analysis today by market participants. There are at least 10 screens. 1. PE of the stocks has to be less than the inverse of the yield on AAA corporate bonds. Second, PE of the stock has to less than 40% of the average PE over the last 5 years. Third, dividend yield is more than 2/3 of the AAA corporate bond yield. Fourth, price is less than 2/3 of book value. Fifth, price is less than 2/3 of net current assets. 6. Debt equity ratio, book value has to be less than 1. 7. Current assets is more than twice current liabilities. 8. Debt is less than twice net current assets. 9. Historical growth in EPS is more than 7%. And 10. No more than 2 years of negative earnings over the previous 10 years. On the other hand, growth investors buy growth companies where they believe that the value of the growth potential is being underestimated. If you are a growth investor, you believe that your competitive edge lies in estimating the value of growth assets better than others in the market. Despite the evidence reported last week that passive value funds outperform passive growth funds over the long term, there might still be some merits to investing in growth. So why should investors choose to invest in growth company? Damodara 1994 shows that active growth investors beat a passive growth index fund far more frequently and by far more than active value investors do, relative to a passive value fund. There are times where growth outperforms, particularly when the yield curve is downward sloping. Hence, market timers may invest in growth at particular times. Let's have a quiz for this material. There are some of value screening in value investing except A. Book to market ratio, B. Price earning ratios, C. Price to cash flow ratios, D. bond ratio. So, this is the end for this module. See you later.